Hello and welcome. My name is James Preston and today I'm sitting down with Chief Investment Officer Ian Wenham of Peak Investment Partners for a brief update about the market. Ian, 2016 ended very differently than it began for investment markets, and you mentioned in your latest market commentary that 2016 was a year of inflection. Can you elaborate?
2016 commenced with major concerns over the lack of growth and deflation. It ended the year where the mood and the sentiment had improved quite dramatically. Growth expectations had certainly accelerated. We'd moved to a world where deflation was far less of a concern, inflation was back. We also saw major long-term trends in interest rates and commodity prices reverse. And so 2016 certainly ended very differently from where it began. The other major feature, of course, was on the political landscape, where if you'd have forecast a Brexit and a Donald Trump victory back in January, you would have got very good odds for that. And yet, of course, that's where we ended up. So again, on the political front, quite a significant ending to the year.
So where to from here?
Well, markets have initially reacted very positively to the Trump election victory. We're now, of course, in the main game, and I think from what we can see so far, it really is a bit of a mixed bag as far as the US is concerned. I mean, clearly things like tax cuts, talk of fiscal spending increases, deregulation, all of those things are clearly very positive for markets. But on the other hand, you've clearly got concerns over trade barriers, increased tariffs, and a range of things which will be negative for global trade. And clearly, if there's lower trade, then over the medium term, you get slower world growth, which is clearly not an ideal outcome.
How are you structuring clients' portfolios to accommodate this changed environment of higher inflation, rising interest rates, and synchronous global growth?
We're in the process of, rebalancing rather than restructuring client portfolios. There's clearly a high degree of uncertainty at the moment around where this year might end up. So to be taking radical changes to portfolios, I think that's somewhat premature at this point. However, we do need to recognise that we are in a rising interest rate world, rising inflation. Commodity prices clearly are in recovery, so we're having increased exposure to some of the cyclicals, and some of the commodity stocks is clearly important, and to some extent reducing our weightings to some of the more interest rate sensitive sectors, which will be disadvantaged by rising interest rates, and also by taking some funds out of some of the more defensive industrials, which again may tend to underperform in a somewhat stronger market.
What risks do you see existing that may derail your generally positive view for equities in 2017?
As far as risks are concerned, I think the situation in Europe remains somewhat volatile. We've got elections in the Netherlands, Italy, France, and Germany, I believe, as well. So it's quite a big year, and all of those are quite important, I think, for the future of the Eurozone. So that's certainly one. The second, obviously, is to do with Trump and where we end up with the US political landscape and the knock-on effects that might have for the global economy. Certainly things like trade wars are a very bad outcome for all concerned. In some respects, Australia, being sort of away from the epicentre of the global economy, puts us in a somewhat perhaps more tranquil situation here. Obviously, our future remains probably far more to do with China than it does with the US or the Eurozone for that matter. And so I think in some respects we're probably perhaps partially insulated, as we saw back in the GFC, from some of these global shocks perhaps have less ramifications in a place like Australia.
Ian, where do you see the markets in 12 months' time from now?
Look, overall we're generally reasonably positive. I say that primarily because we are expecting to see, and indeed are seeing, quite a solid recovery in corporate earnings, which I think will underpin the market, not just our market, but I think global markets generally are seeing stronger earnings growth coming through for different reasons. Ours is primarily driven by the commodities recovery. The US is primarily driven by energy and to some extent IT. Europe is actually benefiting, seeing earnings growth benefiting from a weaker euro. So there's a range of factors that are sort of featuring there. So I think that's an important factor. And secondly, I think there's been an awful lot of company restructuring that's been done, so that companies are getting the benefit of generally very competitive cost structures. So, I think that'll continue. And then on the negative side, housing is probably close to a peak, but our expectation is that infrastructure spending, certainly in Victoria and New South Wales, is showing strong recovery. So I think that'll be quite supportive.
Ian, thank you very much for sitting down with me today and giving us a brief update about the market. All the best with Pete for the next 12 months.